All right. So I'm here today with Muhan Zhang. He is the founder of Startup Investing for All. You can find him on muhanzhang.com. That's MUHANZHANG. He is a mini angel investor, and that's how we got in contact with each other. And he is also the former COO of Andrew Yang's campaign and employee number one or number two?
Employee number one.
Employee number one. So I want to start off this call with a question. Why did you get into startup investing?
Yes, Stefan. Such a pleasure to be here, man. Having conversations with you is always so life affirming. So this is the best way to say it, especially for our audience here, right? In many ways, kind of the first founder that I backed that gave me this 100 times return. I would actually argue that the return was even larger, and I will make that case to you with numbers later. Was Andrew Yang, right? In 2017, he asked me to build his website. I was employee number one. I built the website, ended up doing all compliance, all finance, all and technology for the campaign. And the impact that he has had, and the impact of me working there with him for 3 years is monumental. It's truly monumental. So even to go back to this idea of like the numbers, right? One of the things is that the campaign raised about $40 million over the lifetime of its operation. So you can compare that to a pretty large startup, right? A startup that has raised $40 million in its lifetime. But here's really, to me, what the concept of the return is. So Andrew Yang, after he drops out of the presidential, he runs for mayor. He continues to do his thing, and he's going to do great. One of the things I think is really under highlighted is actually the impact of his nonprofit Humanity Forward. So this is something that is public record, but for some reason, it's not a story that's told very often. It's actually kind of one of the stories I like to tell now in my new role as a content marketer, as an angel influencer, however you wish to describe that role. So Andrew Yang's new nonprofit Humanity Forward spends about $1 million in lobbying. And they help lobby for this 6-month earned income tax credit for every American family with a child under age 18. So literally since July of this year, every American family with a child under age 18 has been receiving $300 a month. And I have like checked in with my friends and family who have children at this age, and they have received that money. That money, when it came out as a total, came out to be about $160 billion. So that means if just from a pure mathematical standpoint, you put $1 million and you unlock 160 something billion dollars of direct cash aid to the American public, to American families. That is like 1,000,000% return. That's about a 10,000 times return, right? There's no venture return that could ever compare to that. So, and the story, I think was something also that I made sense of very much kind of one step at a time. So I had this experience in one sense, working with Yang. And even though at the time it was very much just working for someone I deeply admired, founder of Venture for America, I was associated with that org. In other ways, you could see that as my first kind of success from angel investing, right? I picked a founder who had insane, immense national scale returns. And so after finishing on the campaign, I very much had this concern that I thought, wow, okay, people like Andrew Yang are great. If we only rely on the one or two exceptional people who can pull something off at this scale, then we as a society are in a really, really tough position. Because I remember from early 2017, despite being a twice successful entrepreneur, how much of a grind it was even for Yang to fundraise for his presidential campaign, right? Like by the end of 2017, you can actually see these records because I helped file them. We had only raised about $120,000. If you put that into the context of angel investing, that's a very small round. That's a very small round. And by the end of 2018, we had only raised $600,000. That's like your seed. Yeah. So these are small numbers. And the thing is, again, just a benchmark, right? So if you're a real baller, if you're a full, angel investor, it's very common to cut a $25,000 check. That's like a typical kind of one bullet that you put into your startup rocket. The maximum donation over the course of any political campaign that you can donate as an American citizen at present is $2,800. So that you can kind of see where you're like, huh, interesting. Like, you need to raise many more checks and many more smaller checks from all these individuals. And one of the things I realized was that despite the fact that Yang actually had a very affluent network, right? The guy went to private school, Exeter, then he went to Brown undergrad, then he went to Columbia Law. He doesn't have his network is very well groomed. Many of them still did not have that socialization to cut that check when their friend was starting that wildly ambitious, in this case, a political campaign. But to me, it really was a startup. Like we ran a political campaign as a startup. That's exactly how this rolled. And so I think those two things were bouncing around in my head. And certainly individually outside of the campaign, I had started writing and investing in startups, at that time, kind of, and still I'm finishing that journey now. I'm famous for having a goal of investing in 50 startups, like any other angel investor, but investing only $200 per, right? To really make this something that everyone could get into, because I do think that's something a lot of angel investors don't talk about. Like that you need to have a significant amount of wealth to responsibly start playing this game, right? It's a highly volatile asset. And so when you ask me how did I get upon this, really my goals were, hey, it seems like if we want to surface more quality founder level talent like Yang, the most direct way to do it is to expand that supply of investors who are willing to cut that check, and also to assess whether this founder will have a reasonable shot at achieving their wild outsides thing, right? In my direct work experience, it ended up being running for president of the United States to implement a universal basic income. And I already made my case for the math being there. Like we actually did succeed outlandishly from a numbers perspective. But here's the thing, that's great. There's still so many more problems that we want to solve, from market compatible problems to non-market compatible problems. Can we now expand the supply, right, of investors who are also surfacing those founders in their network? And then that way we can just improve both returns for investors. That's obviously a big part to a sustainable innovation ecosystem, but also kind of encourage and help more individuals take that big risk for whatever ambitious thing they want to do.
I love it. And just very briefly, how did you get in contact with Andrew Yang? How did you get involved with that project?
I was a Venture for America fellow in 2015. And so Andrew Yang founded Venture for America. I participated in the fellowship as a fellow. And so from 2015 to 2017, we had a loose, friendly relationship. He was the founder, the figurehead. And I had read, I have to this date read every single book he's written. And many of his ideas really resonated with me. So actually a fun fact that a lot of people don't realize is a lot of the problems that his presidential campaign to address were really rooted in his work in Venture for America in a really deep kind of way. So among which was Venture for America was trying to create more innovative startups in these emerging economies or recovering kind of post-industrial economies in order to create more gainful employment opportunities in those cities. Right. And so kind of one of the themes we talked about as an organization, as a community was, well, we're creating some startups in, say, Miami or Birmingham or Cleveland or Cincinnati, but the number of jobs that these startups are creating is pales in comparison to, say, what Ford was able to make back in the day, or what kind of more traditional manufacturing and large scale industrial employers were able to make. So those, I think, deeply trying to solve at Venture for America helped Yang come to the conclusion that we were solving the problem the wrong way. We're pouring more water out of a leaking boat, as the analogy he likes to say. And then I think that is what pushed him to intellectually entertain the audacity of a universal basic income and then figure out how to fund it. And so in 2017, when he was running, he called me because I believe in 2016, right after Donald Trump won, we had a set of email exchanges back and forth just about kind of like what it meant, right? What it meant that Donald Trump won. Truly, it was inconceivable. He was going against Clinton, right? Clinton, that race was hers to lose in 2016. So that was how we got in touch.
So he just reached out to you and was like, hey, help me. You built a website for him, you said?
It really is as unglamorous and as mundane as that sounds. Yeah, it was April of 2017. He called me at work. I think it was like 3 p.m. Eastern time. And he called me and said, hey, I'm running for president. I was like, what? He said, what? I'm going to run on a universal basic income. And I was like, okay. And he was like, yeah. And I want you to build my website. I was like, okay. And it's like, it's really, he's not hyperbolizing when he says like, yeah, when he first started fundraising, it literally is just from his Gmail. Like there's no, wow. list. Yeah. It was extremely homemade, so to speak.
Grassroots. Yeah. I like it. Cool, man. So I want to talk a little bit more about your investing. You said you're investing in 50 startups at $200 per. How many have you invested in so far?
Man, I have to do that total recently because I will tell you this, man. One of the exciting developments this year relates to my business as well. My business is obviously an evolution. Is I have started to realize that I have significant deal flow from my professional network as well, and that's been really really cool to watch. So I started off my investing on the $200 equity crowdfunding. Everything's public, right? Very much investing in public, right? I can see their financials. I can ask the questions in financials. The executives have to respond publicly. And as it turns out, when you show your work like that, founders, investors, readers think like, oh, if that's the quality of your thinking on these companies publicly, then we would love to get your thoughts on stuff that's like off market, or founders kind of like, oh, I really like your content, I really like the way that you think about stuff. So that's been very positive. I'll say kind of, if you were to take all the companies I've invested offline, which is kind of new and emerging but significant, and the companies that I've written deal memos, have had upper rounds, whatever have you, it's probably getting to be about 30 at this point. It's like 30, give or take more. I have to get that number to be a little bit closer, but it's a significant portfolio at this point.
That's quite a lot. And I remember Lauren in the group, she shared some IRR information, and I forgot the name of the guy, but it's some guy in San Francisco. He had compared all different deal flows from his private network, from just randomly investing in companies, and his most significant IRR was from his private like deal flow, where he got intros to people.
Yep.
So I'm curious if you've seen any improvements. It's probably too early to tell now, but improvements in your IRR from doing private deals.
As of right now, you are on the money. It's a little bit early. I think I just cut 3 checks in the last 2 months. And so it's the wires have just cooled off. But I wouldn't be surprised. It's really interesting because in many ways our community, right, the startup investing for all readership had a very good spider sense that I would have deal flow. And I think it also comes from my, kind of very public journey growing as an investor and gaining confidence in that. But the deals that I've gotten recently have been lower valuation, earlier life stage, or more traction. And those things all make sense. Do I think that they will go to equity crowdfunding at some point? I do think so. But do I think that equity crowdfunding also has more obvious advantages for a very certain type of startup, right? Something that has like a lot of stakeholders, sometimes like a marketplace, so you can get your Uber drivers and your riders to kind of take equity stakes in your company, et cetera, et cetera. It definitely has a more obvious, compelling vision to Summit right now. And so I am excited to see how that comes about. And I will say that I think we shared an article in our news channel talking about this, but you're seeing the rise of a lot of micro influencers or writers or individuals who essentially are absolutely just monetizing their network. It's not that, it's not that complex of a strategy. It's like, this person is smart, so they probably socialize with smart people. Like, if you invest in a basket of smart people, you'll probably do reasonably well, right? Is the idea there. And so I'm excited. I'm very, very excited. Again, I think what I aspire to do in my writing and in our community is very much democratize just the thought process and the socialization for how to make that investment. So even when I'm investing in companies off market, even though I'm more inclined because they're coming to me, right? These are people from my network. I still apply the exact same criteria that I do for my public stuff. I'm still looking at what the burn is, how much runway do they have? Do they have revenue? Are they B2B, software, hardware, et cetera, et cetera. And so that's been a real, in a way that's almost exactly what was planned for, but in a way that's also kind of performed better than I would have expected. The multiple reps, so to speak, of doing deal memos on hundreds of equity crowdfunding companies has really made me very comfortable with cutting, larger off-market checks.
Got it. And for those of you that don't know, what is IRR? And I'm curious, what IRR are you shooting for? Like, what would make it worth your while?
So IRR is it means internal rate of return. And across all different asset classes, we have like different ways of talking about this, right? But essentially it's like, how much more is your money worth today than it was last year? And so in real estate, it's oftentimes the capitalization rate. For low fee index funds, that's probably something that many people are very comfortable with. Like 7%, year on year returns is the goal. And the big thing about IRR as well is that it is compounding, right? So it's not not like a capitalization rate where your where your rate of return is fixed depending on kind of how you leverage the asset and such. So Bessemer Venture Partners has this really great slide deck. I think I've shared it before, and I kind of use that as my benchmark. The last time I did my IRR calculations in 2020 across the companies I invested in, and this is very fair because it's very early. I only started investing in startups in 2018, so that gave it call it a year and a half to 2 years of data. At the time of companies that had an up round and of companies that are still in business, which was all of them at that time, my IRR was a little bit north of 20%. To put that into context, right? So 7% is what the low fee index funds give you back. And so if your return as an angel investor is like 7%, you're barely keeping up with inflation, adjusting for risk. That's the big one. You really could have just done nothing, put it into a low fee index fund and get 7% as what one would predict. Great. 10 to 20%, you're like doing fine, middling, struggling, doing kind of what you're doing. 20 to 30%, you're in the top quintile, so top like 20% of investors. But really, once you get that 30% IRR and above, you are kind of like a legendary investor. You're in a really good category. That's like Sequoia, that's like A16Z, I imagine for some stuff though, And what's interesting is to complement the IRR though, and this has also been something I've been watching. One thing that's really interesting about the venture space right now is that there is this paradigm shift that's starting to think about what value do VCs add. So that asks, what value does VC add? And one VC in particular is adding some really provocative thought to this, which is Tiger Capital. They are just cutting checks like no one's business. They think that VCs are mainly useless. It's really like they kind of outsource a lot of their due diligence to the traditional VC firms like Sequoia, A16Z, or whatever have you. And then they just back the check. They're like, great, just take the check and move faster. Because to them, velocity is not only more important from an absolute standpoint, but velocity as a brand, right? Like if a founder is thinking of who to get capital from, yes, someone who just doesn't waste time, just cuts a check within 7 to 10 business days, very, very valuable. And so what that means is, even for me now, I am starting to realize that I'm playing with my personal capital. So I obviously don't want to lose money. Great. That is one. So IRR is the most absolute way to see like, okay, how much money are you making, right? So that's one aspect of success. The other aspect of success though, is to say like, okay, yes, your portfolio is going to have many companies that don't make much money or return, 50 cents on the dollar, 25 cents on the dollar, 10 cents on the dollar. The other question though, is do you actually have the vision to spot companies that give you 10 times, 20 times, 100 times returns? And that is valid from an investment standpoint, because if someone could say like, okay, yeah, maybe you were a little bit not disciplined enough in terms of limiting your losers, but you do actually have enough vision for like seeing who could go big. That is very promising. And that's something you can fix as an investor. The alternative, which is, okay, maybe you're not bad at choosing losers, but you're not aggressive enough to pick like the big winners, right? I joke all the time. Given kind of my professional background and my investing background, 9 times out of 10, I probably would have missed a Twitter if it came in through my deal flow, for sure. Like social media, advertising, selling eyeballs, like that's not what I like. It's not what I like my dollars to back, even though I understand there's value there. And so 9 times out of 10, I would have missed it. That's not a good thing for me as an investor. I should be more aware of that, and I should be trying to curb that where possible. And so I hope in addition to IRR, which is like, again, just like a hard numbers, the other side is there is this qualitative aspect, which is like, okay, if your numbers, like, how did you do? Now, I'll even end this anecdote with one last thing, which was if you took out maybe like 2 to 3 of my poor investments from when my calculation in 2020, my IRR actually automatically jumps up to 25% and above. So what that means is I chose some really bad bets that have had no up rounds for a year and a half to 2 years. And in retrospect, I know why that is. I backed hardware companies that were pre-revenue and still funding R&D. Right? They have gained no meaningful market value since the time I invested. That's totally fine. But as someone who is investing, with my own money, and as someone who is trying to demonstrate a certain level of competence in the art of angel investing, that is not an investment I should make again. Right? There are plenty of hardware investors. There are plenty of rich people who don't need to calculate an IRR. For me, I need to demonstrate a certain level of seriousness. And so even that, to realize like, okay, next time do not back a hardware drill company, right? Stick to software. That's what I like. It's what I know. It grows faster. And then, kind of expand the circle of competence from there. Like that's the type of cool learning that I'm having as I'm proceeding on this journey.
I like it. I like it. Going back to your private deal flow, are you investing $200 in these companies too, or are you investing more? Or?
That's a very good question. So at these numbers, once you get to private deal flow, the legal fees for sending like the safe notes and things like that actually become quite significant. So it depends on the founder. Like a founder can let you come in for $1,000, $2,500 for friends and family. But generally speaking, what I found is that especially if it's one of my friends, you're kind of coming in between the $5,000 to $10,000 check range per. And really, if you're like a formal angel investor who's just investing in things formally, people like $25,000. But I think my founders have been a little bit more generous to say like, hey, we'll accept a smaller check, right? Because you are someone who has brand equity and audience, you have this work experience. So that's generally kind of the range that's coming in at.
Got it. I want to go back to the thought experiment that I mentioned in the Discord channel. So my thought experiment was you take $25,000 and you invest it in 100 companies. That's $250 per company. But what you do is you scrape all of the startup data that you can possible. So you go on Crunchbase, you go on PitchBook, you go on venture capital websites, you use Coinbase, you go on all these different websites, and you basically just scrape all of this data. And then what you do is you see which companies, which venture capitalists are investing in those companies. And are those companies under a $10 million valuation? And then what you do is you try your best to create this list and then invest in each company individually for as many as you can. Hopefully there's 100 of them. I'm curious if you can use that model to angel invest rather than doing without even doing due diligence, without just going in and investing because you know what? A16Z invested, I'm going to invest too.
Yes, the answer is yes. You could absolutely do that. And in fact, I would say what you have just described is honestly what most angel investors do, including myself. So to put this into perspective, so recently I cut a check into a advanced materials startup. They are post-product. They haven't gotten to large scale yet. They're not publicly available, but they are already starting to do paid pilots with some key manufacturers, and they are on track to scale kind of in Q2 of next year. So I have a computer science and a business background. That's what I studied in undergrad. From there, I had facial recognition, education technology, and then I had success on a political campaign. And now I'm in media. So none of those backgrounds has anything to do with advanced material sciences, right? I'm reading about kind of like photoreactive materials for sterilization. It's very, very STEMmy kind of stuff. And I love that. One of the things I love about this job and about what we do is that you get an excuse to learn about things completely randomly in a very serious way, right? Now, because I cut a check into that company, and I think we've been talking about it in the Discord as well. I've been very excited to see that company has raised an additional, call it, I'm part of the influence, but an additional $50,000 from their round because I've been able to put that influence in. And again, I'm not a domain expert. I'm not going to pretend like I am, but I'm someone who's willing to go read the stuff. I have some basic STEM background, and I can check out and say like, okay, from what I know about the competitors, do I think that the competitive landscape makes sense? Does the technology work out? And will the demand be there? Like all these things. And so essentially what I'm saying is that my co-investors, my investor friends have absolutely just done exactly what you did. They did some semblance of their due diligence, but they are also not super STEM heavy people. But ultimately what they said was like, all right, Muhan is a legitimate guy. Is he going to lose on some investments? Of course. But do we think that generally speaking, his judgment on which companies can go big is more legitimate than not? Absolutely. Right. And so in this case, I can't possibly compare to A16Z, but also I am cutting a check in a much smaller company. Right. And so if you're I think you understand, like Instagram's $250 million round by A16Z is a very different calculation, right? It's more like private equity at that point than it is like angel investing at this level. So the thing though, so intellectually speaking, what you are saying is completely feasible. If you were able to find, gather all the data, every single startup under $10 million has a lead investor that is someone you respect and you throw money into it, you'd be fine. You'd be very, very good. That would essentially be the gold standard low fee index funds of angel investors. And I would argue that every angel investor somewhat has a model of that with like, okay, I don't really understand it, but I trust the founder and like the technology kind of checks out. Let me cut my check. Here's the rub of it, I believe. Here's the tricky part. Everybody would want that. Everybody would want that. And that's what also makes it so that the quality deal flow that can do that, right? If you are getting into a $10 million company that's already backed by A16Z, you are a very lucky person. That's really what it is. It means the founder likes you. They're like, Stefan, I love your podcast. Or like, Muhan, I really love that you tried to, cancel child poverty. It's like, like they are choosing us. And that's why so much of also what we do as angel investors is trying to not be dumb money, right? Like what else can we provide such? How do we market ourselves and our capital to these founders, right?
I like it. Yeah, you mentioned the part about being lucky. You definitely have to be lucky to get an allocation at under 10 million when A16 invested. But I'm curious if there's enough companies on, let's just go to CoinMarketCap. Do you think there's enough companies on there under 10 million that could be another Solana or Ethereum?
CoinMarketCap.
So that's basically a list of all of the publicly available coins you can invest in. So there's probably 13,000 of them on there. I don't know if you're familiar with it.
Tell me a little bit more. I'm floating through it. I see this is a really interesting thought experiment and a bridge that you're making. So at this point, I believe intellectually, you are saying that new altcoins could be a interesting proxy for new startups, which I think is a legitimate argument. That's the valid point. Cryptocurrencies from an assessment standpoint are meaningfully different than startups only because startups are real businesses, right? And so cryptocurrencies are in this new exploratory phase where it's like, okay, what's going on here? And what that means is I think a lot of it depends on, like, people say this all the time, right? It's like Bitcoin is digital gold, Ethereum is like digital oil, right? It's like, okay, what is Web3, right? And so there's all these analogies that are going on there. So I guess if I was to take a speculative guess at what you're saying, and I say this as someone who is invested in crypto, and certainly I spent some time learning about it, but I would not bill myself as a crypto expert, certainly. It seems like the features for which crypto are competing against and what they're kind of essentially what a cryptocurrency's market cap is based off of is in many ways kind of based off a lot of the metrics that we look at in a startup, even if it's not profitable yet, or even if it's not growing. So among them are like simultaneous number of transactions that it can hold, right? Among them is like large investors that have invested in them. Like Solana actually has Solana or FTX, I forget which one, actually has A16Z backing into it, right? The Miami, the American airline arena in Miami is being renamed to FTX. And like the Staples Convention Center, the Staples Center here in Los Angeles is being renamed to crypto.com, right? So you're like, oh, interesting, like big bucks are going on there. So by that point, I would say then the core question that you are asking is, do we think on all of CoinMarketCap.com, there is another cryptocurrency that's going to be either something to compete against Solana or a cryptocurrency that solves a real life problem and is good enough on the metrics that CoinMarketCap reports on, that will then give you that return. Now, out of curiosity, I mean, what would the return have to look like for this to be a worthwhile intellectual endeavor?
Well, it depends on what the dilution looks like too. But I would say, assuming no dilution, I mean, if you invested in Solana when it first came out, you'd make like a 20,000x.
Wow.
Yeah. So if you do the math, I mean, even $100 is a lot of money.
True. Yeah. I just did the math here. 250 at 20,000 would get you 5 million, which is very, very cool.
Yeah. So I'm just like, I feel like if you're willing to lose 250 or $25,000, like I feel like the upside could be enormous. I don't know. Right. It's just, it feels like a new, and for me, like I'm not so big on like doing due diligence. Like that's just not what I do. I'm more of a builder myself. I like making stuff. So Absolutely. I'd rather just throw my money in something that will make money in the future and have someone else do all of the work. And I just do what I actually like to do.
Totally.
Kind of automate it in a way.
It's interesting because I would argue that Tiger is doing exactly what you're doing, except they're doing at much larger check sizes, right? But yes, I would agree with that. And it's interesting because like we are in this entire journey of figuring out how you democratize access to that type of opportunity for the retail investors. Because right now, the very luxurious kind of credited investors do maintain proprietary access to that type of stuff. And oftentimes they do it through sheer access to capital, right?
Right. Yeah. Speaking of accredited investor, are you an accredited investor?
I am an accredited investor. Yes, it was
Okay,
something that
cool.
happened in 2020 in kind of my angel journey, and it's something that I will say it's my mission is still to make angel investing uh, accessible to everyone, including unaccredited investors. So I think when that shift happened, it threw me off. It caught me by surprise for sure. And I think this year, partially one of the reasons that I think maybe deal flow has been coming to me more often is like as I've grown more comfortable into that and realized like, oh, okay, cool. This is it's an interesting process because I'll say this as well. Angel investing is different than other forms of investing in some senses because I believe so much of it is very aspirational, right? Venture capital is a very sexy industry. It's a very sexy form of investment. And what that means though is that there's a lot of socializing that you have a socialization. And that really goes back to kind of my core mission, right? Where I'm trying to find more founders like Andrew Yang in all their various industries and sectors. Because then if I can find them and I can train the market to socialize and cut that check more, then life looks very good. So even for me in that experience when I started, I was definitely not accredited in 2018. And I'll say this mainly kind of I would say the first investment in industry sector. Anyways, I've had some conversations along this portion of it. I would say from the $0 to $1 million net worth range, the only asset class that most normal Americans, and by normal Americans, I do mean unaccredited Americans, like who I was in 2018, 2019, should focus on is without a doubt real estate. The only reason is because in America, we have this really interesting history where for real estate, even if you do not have that much money, as long as you have a job, the federal government will back up multiple $100,000 loan to you to buy an asset that you can leverage, and it's stable enough that you can get the upside swings without having to worry about losing your shirt, as long as you're buying a real estate property that has kind of rents to justify the valuation, right? It always goes back to, is this thing worth it, aka how much money does it bring in? Like what is that rent to purchase ratio? What is in startup the revenue to valuation, in cryptocurrency maybe transactions to valuation, right? And so once I think those engines of investment for real estate helped me get to the level where I was accredited. That was what again caught me a little bit off guard, but even I have experienced that kind of socialization factor that has now brought me off market deal flow.
Very cool. So connecting the dots here, you basically made your nest egg through real estate.
Absolutely right. So I worked,
cool,
had a job all through Yang, built my real estate portfolio at the time through all the investments, got my first nest egg through real estate. That was actually, kind of really threading the needle. That was actually what really gave me the kind of blue sky thinking to think, okay, in my next job, what do I want to do, right? Going from politics into becoming an angel investor and kind of running a content business was not the most linear hop from a career standpoint. So I think it was realizing that real estate was able to support me from in a meaningful way, not like a mega baller, but like enough in a meaningful way that I could take on more risk. That was what led me to then starting my content business. And my content business obviously builds my audience, has a brand, shows founders and investors how I think. And then that's like a very large kind of virtuous flywheel where then more deals come in, more investors come in, more subscribers come in. And that's kind of where I'm currently at.
Very cool. Very cool. I'm also interested in getting into real estate, and I want to kind of pick your brain on that a little bit. So did you become accredited through like selling, or is it just having a certain number of assets that produce enough to basically say you have $1 million in net worth?
That's the one. Just building a really large portfolio. Yeah, for sure. For sure. You got it.
Cool.
You got it. Mm-hmm.
So one thing that I think a lot of self-employed people struggle with is, how do I get a loan if I like to expense a lot of things? So are there any kind of, tricks or tactics you could tell us about there?
Yes, sir. No, this took me a long time. I'm actually really excited to share this, and I will give this note. I hope that listeners, any of the viewers of our show today, who may have seen my other content, don't feel that this is coming out of left side. I don't talk too much about real estate because there's so much good content about real estate. So I haven't really
bigger pockets.
Yeah, exactly. Bigger pockets, and I've consumed it. I also want to give a shout out to Paula Panta at Afford Anything. I mean, she's great. She's a woman of color, female, kind of entrepreneur and like really high quality content. So I've just when friends are like, how do you calculate cap rate? I'm just look at anything like Afford Anything does. They're fantastic, very funny.
What's her name again?
Paula Pant, but her website is called affordanything.com. She has a lot of really friendly, really high quality content. And she's very real. She has, I think, 5 investment properties in Atlanta, Georgia. That's the market that she's in. So to your question, because I actually had the same thing. So once I became self-employed, I was trying to tap into the equity of 2 of my properties that I have. And I was stressing out. I was like, oh, how to get it? Can I no longer expand? And finally, it really was 3 things that finally clicked for me. And I'm very happy because one of the loans has been closed. So that's like done. So I can tell you for sure that works. And the other one, I'm hoping to close by the end of the year. So I unlock more equity and then I have more dry powder. I can go and buy more properties. So what it is that one, number one, you have to get a real estate CPA. Because I used to do this. I used to, during the Yang campaign, we talked a lot about the kind of like mindsets of scarcity and abundance. And so scarcity is this idea where you want to conserve resources, right? So I so had this idea of conserving resources to the level that I was still doing my own taxes, kind of using a lot of these self-prepared services. And so I would do exactly what you were doing, where I would, kind of expense everything, make my income look very low. Therefore, I don't have to pay as much in taxes. Here's the rub of it, right? And in this sense, I think the American taxpayer system is actually very, very fair. If you want to self-report your income as very low, then they will charge you less tax. But then if you report your income as very low, the bank will have to take it at base value, even if they know that you're making more money from a cash standpoint. Right. So the CPA who has a real estate background will help you navigate that background of reporting forthrightly your income, but also at the same time. So that means you will pay more in tax. But what that means is you unlock all this financing because the bank can now, give you financing as a profitable business rather than saying like, well, we know you're making this business in cash. Right. Exactly. So that's just kind of, I think that's just the cost of doing business. I think I have made my peace with it. I let my CPA take care of it all. That's one.
So do your taxes for the first part.
Do your taxes.
Pay your taxes.
Pay your taxes for the first. Just admit that you are in a business making endeavor and you have to pay your taxes. That's one. And 2 is, and we can connect offline about this as well, in terms of like specific recommendations if you need them. But 2 is once that clicked for me, that a CPA with a real estate background could look at my taxes and say, hey, you absolutely can get more financing, but your previous CPA / you yourself, really wrote your expenses off in this way that makes it so your debt to income ratio, whatever, how it doesn't make sense. The second thing is really going for commercial financing, right? Like I think a lot of us as real estate investors, when we go from the scarcity standpoint, we also really, really, really want to game the system, and not in an unfair way. This is totally illegal, but you want to do your owner occupant, you want to do your FHA, you want to do your 3%, 5% down, you want to get that 3.5% residential loan. I totally understand. That is 100% where my mindset was before. Now I've completely made my peace. I'm like, I am buying these properties to make money. And so, yes, is the bank going to charge me a higher percent, like, 1 to 1.5 more basis points because I am doing this as a commercial property? Absolutely. Doesn't matter. I mean, my commercial rate that I just closed on last month was 4.125%. To put that into perspective, I mean, I work with my mother. We're very, very close. She has, she's full-time, a teacher, but she has done real estate on the side. And what she told me was, she said, when I bought our first home in 1998, the interest rate was 7.8%. Right. So you always have to like put this stuff into context. Like all real estate asset prices are like speculatively high because money is essentially free right now. Right. Like for me to do a commercial at 4.125 is insane. So in that sense, yes, 1, pay your taxes. 2, and just accept that the right way to go is a commercial loan. And what happens is once you get a commercial loan, they do not care. I mean, this time they didn't ask for a W-2. All they wanted to make sure was I have enough cash reserves. They made sure that my rent rolls were good. They made sure that I had a property management team that has done everything appropriately. And then they closed on the loan. And so I'm hoping to do it again, actually, this time with a commercial property. So that was for a residential property. That was for a 2-family commercial loan. So it's a commercial loan for a 2-family. And so the upcoming property I'm trying to get the financing free from is actually a 6-family. So if I get a 6-family property to get that loan out, then essentially I will be able to buy, rent, repair, refinance properties forever without, kind of like external validation.
Got it. So I've been reading about commercial properties and multifamily homes, and Is it true from a practical, like, is it true from your perspective that it's easier to get a 6 family loan or 6 unit loan than it is a residential loan? Because they look at cash flow.
So in the past, I was again like my mindset was conserve money slash get the lowest rate, right? So I was only looking at it from a residential standpoint. And so in that sense, the commercial property was not as good from so I was very much focusing on it from the rental side. And like I said, the reason why I love real estate for anyone who has kind of like $0 to $1 million net worth is because without having much assets, the federal government will back you as long as you have a job, right? And that's where I was in my last 4 to 5 years of my career. And so the residential loan was definitely easier to get than the commercial loan previously before. But I think the other reason as well is because, when I was gearing for residential loans, I wasn't doing my taxes for a commercial loan. Does that make any sense?
Right.
So once you transition to the commercial loan space, I would say that in my experience, it was really hard to get my first commercial loan because I'm self-taught. I don't really have kind of like real estate mentors or real estate people who can teach me that stuff. And so once I navigated to the commercial real estate side, there was a lot of things I had to change in my mindset, right? I had to get a serious CPA. I had to start thinking about things as a cost of doing business instead of just being like, I'm paying more, interest rate, even though I'm the same risk as when I was a residential. But if I close on this loan on the 6 family by the end of December, I'm actually in talks with a private lender broker who has access to kind of more lending, and they're straight up telling me, they're like, Muhan, at this point, you have 5 investment properties across 17 units, right? So each of them is multifamily. We would be willing to loan you money to buy, repair, rent, and then rehab properties up to $2 million. That's like breathtaking for me. I've never worked on anything on that scale. And, not to say I would use all of that because, you have to pay back the money. This is the key. But to say that it's kind of unlocked for me on my real estate side, like a new level of thinking about like, wow, yeah, like buying a 6 property, an 8 unit or a 10 unit, even like a 15 unit really doesn't matter anymore. Like I don't do the management, I don't do the repairs. I just do all the financing and the paper management, all that side, right? I'm kind of like the CFO. And so that I would say, I hope if that speaks to the question that you're asking, I think it's much harder to get started in commercial. But once you get started in commercial, because the bank takes on more risk and all these things, it does become truly just numbers. It's like 6 to 8 to 10 to 12 to 18. Like it doesn't. I think after 20, you get to some weird space where they're like, okay, now you're essentially like a real estate development company. And I'm like, I'm just a dude, right?
That's funny. You mentioned the 2 million, and I'm like, 2 million in Austin would buy you a basement. It is so expensive here.
That is, well, here's the other thing I'll add as well, right? Like my investment portfolio is all in Providence, Rhode Island. Right. And so I used to live in New York when I worked for the Young Campaign. I'm currently living in LA. And then kind of where I've born and raised is Boston, Massachusetts. And so neither of those markets, and during Venture for America, I lived in Miami, Florida. So something that's really hard, I think, for us to accept as like young professionals is that most of the places that we would work and live are generally speaking uninvestable. Generally speaking, like in New York, the cap rate is like 3%. If you get leverage, you're ending up paying you have to pay your bank to own that asset. And it's just because like people know that these cities will be relevant for a really long period of time. Personally, I believe that kind of like the bedrock of what America was built on was affordable housing, affordable housing at very, very large spaces. And so I love places like Cleveland, Ohio. Love Cleveland, Ohio. Shout out to Justin Bibb, who just became mayor. That's actually the first political candidate I backed who won. Fantastic, right? Birmingham, Alabama, Baltimore, Maryland, Philadelphia, like all of these places that are, investing is where you pay a cheaper price for something valuable because you believe will be more valuable in the future. If there's no alpha that you have to say like New York's going to be relevant in the future. Everyone knows that, right? And so the returns are really, really low. So to what you were saying, I'm actually surprised. I thought Austin would still have more juice to squeeze out of it, but it makes sense. Yeah, like you guys have had a lot of wins, a lot of angel investors. This is a vibrant community down there, and so even thinking like a little more expansively, like okay, like what would be the next market in Texas that has more of that growth potential, right? Like where are people moving to in places that are maybe not so obvious yet, right? So like, I guess to put like a cherry on this, I looked for investment properties in Boston and Miami. So Boston, my hometown, and Miami, where I was working from 2015 to 2017 for 2 years. I looked at probably minimum 100 deals. I could never make the numbers work ever. I could never make it work. And it wasn't until I shifted my thinking and chose a better market, which is Providence, Rhode Island, that the numbers worked fantastic. I mean, to put this into perspective, my first property my first property to buy and repair it was $170,000 for a 3-family. So this is a house with 3 apartments in it. And the rent was $2,700. Okay, so if you do 2,700 divided by 170,000, the percentage ratio on that is 1.58%. That's the rate. That's the percent. And so, kind of in real estate, you're probably familiar with the rule of like 100. So the rule of 100 inverted is you want to have at least 1% of you want to have your rents be at least 1% of your purchase price. So I have my rents be 1.5% of my purchase price, right? So that deal is like no matter what you do, then afterwards, kind of with the forced appreciation, with the rents going up, I was able to make my money back on all 3 of my first properties I did in Providence just because the fundamentals were so good, right? So I'm very, very pro emerging cities. I'm very pro kind of unsexy cities because really that's like where most Americans actually have to live and like build their wealth and live their lives.
Right. Oh man, I have so many questions for you now.
We can do a part 2. I'm glad. Like I said, cool. I don't talk so much about real estate because there's so much good content, but I got a lot of love for it. You know, it's the engine for most normal people, and like most of us are normal to start off with, right?
Right. So my next question is about similar in the real estate space. If you could buy a 4-unit place anywhere in the United States, where would you look first?
4-unit anywhere in the United States. Where would I look first? So first of all, I love 4 units. I still have yet to buy a 4-unit. I would love to buy one. So this is like my daydream question. I love this question. Second of all, I'll say this. It is actually I have a very good friend in Boston who has a 4-unit in Boston, and he's originally from Texas. And so what's interesting is, yes, I know you can buy theoretically properties anywhere. There's a national market. There's really no limitations. I'm still like, in some sense, I actually think what you're asking about this question is how do you choose a market? Is that a fair question? Fabulous. Yep. So for me, when I chose to invest in Providence, Rhode Island, there was both quantitative stuff and then there was qualitative stuff. Quantitative stuff was, like I said, I was able to buy a property that was 3 units, $2,700 a month in rent for $170,000, right? All in, all that stuff. So there's the metrics there. Qualitative wise, though, I think is equally as important. And I would say that, in my career as an investor, both in real estate, both in crypto, both in startups, in a variety of things, like the qualitative stuff is just as important because the qualitative stuff does influence your decision making. So what that means is like why I invested in Providence from the qualitative side included, 1, Providence is 40 miles driving from Boston. That's actually insane if you think about it. I remember living in Miami, people would drive 2.5 hours from Boca down to Miami to work and then drive back up. So I was like, wait, this is all part of the same metro zone. Actually, very fun fact, just specifically about Providence. The census actually counts the city of Providence as part of the greater Boston metro area. That's like how close it is. So to me, I was like, all right, so if Boston's going like this, at skyrocket pace, then I can't see a version of reality where Providence does not appreciate as well, because literally it's a train away, right? And I see that, by the way, similarly for Philadelphia and New York, Baltimore and Washington. There's a lot of these, and that is so 1, it's like very close to my hometown. 2 is, there's a lot of universities in the area. Brown University is there, RISD is there. 3, it's the capital of a state. No matter what, like Rhode Island is still a state. It's not going to, if it goes bankrupt, like the federal government has to figure out how to go through bankruptcy, kind of like Detroit with Michigan. And so 4, Providence is the reason that my mother immigrated to the country. So she got accepted into a grad program at Johnson & Wales University in Providence. And so there's something like very spiritually satisfying about being able to reinvest in the place that brought my family here, right? And so I say those things because, none of those have to do, well, some of them have to do with kind of the fundamentals, but all those things help me stress less as an investor when I broke into a new market. And even when I look at like how I found my property manager, that was because my mother is a teacher. And so she has friends. And so she kind of asked, her union teacher friends or whatever have you, if they knew anyone in Providence. So we got a word of mouth recommendation for our property manager. So I think when you choose things that are qualitatively comfortable to you or closer to you, or you have some kind of connection to, it actually reduces a lot of the risk and it makes it much more comfortable for you to invest there. So that's a long way of saying like to bring it back. Like I think that's why it makes a lot of sense for me and my team to invest in Providence because of my roots there. And now, now we have a advantage and now we're just kind of expanding there. But for any investor to choose like what market they would go into, I would encourage the same kind of thought process, which is like if it's closer to you, if it's something that feels safer to you, you have a connection there. I think that's a great way to go. In terms of answering the question, right? I do think that there's, if you wanted me to drop some specific cities, like Detroit is fantastic. I actually think Detroit might be a little bit more expensive now. Cleveland, I only hear amazing things about. I hear Columbus is actually a little bit overpriced now, which is very interesting. Cincinnati, I visited before, great housing stock. Interesting. I will say I don't know the industries as much there, so how that growth will go. Only time will tell. Heard great things about Birmingham, Alabama. Baltimore and Philadelphia, I've both mentioned as well. Trying to think any other cities that I've heard. Here's a really random one that's kind of not on the Eastern Seaboard. Bakersfield, California, I hear is where like the only investment place in remaining in California, kind of old oil country. And in Texas, yeah, you've got your three, right? You've got your Houston, you've got your Dallas, you've got your Austin. But even in like in Texas, I don't know if this is quite right. You can call me out on my knowledge here. If I believe Brownsfield, is that where SpaceX has moved a lot of their kind of like operational things. So maybe there's stuff there. I've heard good things about Plano, Texas. Actually, one of the companies I invested in, I'm really excited about them. They're called Doorvest. Actually, this is a really interesting way to prove this market. I'll have to check with the founder exactly. But Doorvest, to give you the 30-second pitch, they want to democratize financial security for every American. I love what the founder is working on. He also, by chance, happens to be Asian American. So I do think there's another one of those like immigrants trying to sell financial security for American consumers. There's a part of that story that really speaks to me. Anyway, so what they do is they buy, repair, rent, and then manage single family homes for investors who want to have exposure to the real estate class, but like don't want to be landlords. Now that's obviously in single family homes, but the markets that they are investing in, and they have like data scientists who are crunching this throughout the country, right? They are investing in Texas.
I was just looking at Plano recently, and there's a lot of beautiful homes there too. I mean, it's just a great area overall.
There you go. So it's I believe that in this decade and honestly in the upcoming decades, like the great thing about real estate, it's so stable. Horrible thing about it is it's so painfully slow. And a lot of the people who work in real estate, like very candidly, are like not the brightest bulbs in the shed, right? And I mean that with all the love in my heart. It's really rough. Like some real estate agents, some contractors, like I've had to really like manhandle some grown men and women in my real estate career with all the love in my heart. But I think there's definitely still tons of opportunity to like, to open your mind and not just be focused on a few kind of like superstar cities. There's lots of great places to live in America that just need some TLC.
Got it. Yeah. And, I can't help but be skeptical about how many mortgages are probably getting funded this year, last year, and probably next year too. Like, are you skeptical at all about what's going on with the housing market?
It is a great question. And I do believe it is because we came of age at a similar period of time. Here is my statement to this on this. Wow, this is turning out to be a lot more about real estate than we expected, huh? As long as it's fun, like I said, we're hanging out, man.
I'm just exploring my own curiosity. So whether they like it or not, I'm going to timestamp everything and they can jump around if they'd like to.
Fabulous. Thank you for doing that, dude. That's super, super fun. In terms of, so I don't know how old you were when the financial crisis happened, but I do think that the financial crisis in 2008 was probably like a defining era, right? Like we had 9/11, 2001, dot-com boom, all that stuff. But like, 2008 was, they were like the recession to end all recessions, right? So there's a couple of things that I've in my experience, and now I've been investing. I actually started investing in real estate at around the same time that I made my very first angel investment. And so now it's been about 4 years and I'm coming up about 5 years. And I'll say that it's been very, very gratifying to survive, and not only survive, but like comfortably survive a major financial correction, which is COVID, right? So during COVID, tons of people couldn't make their rent. And one of the things I used to joke about when I lived in Miami was, when I lived in Miami, I always joked. So Miami is a city that's sinking. This is something that we know. Climate change is real. Fantastic. Great. And so a lot of young people, a lot of my friends would say like, oh, I'm really nervous to buy in Miami because it's all going to be underwater. And one of the things I said to them was like, um, not to be really misanthropic here, but if you invest in what rich people invest in, you're going to be fine. And like, who is it that owns all these condos in Miami, and who are they're building for? It's like disproportionately for rich people who are parking their money, right? And so here's like what's going to happen. People are going to buy in Miami. Climate change is going to happen. Maybe technology gets better, so it never sinks. Fantastic. Maybe technology doesn't get better and it starts to sink. And let's assume that 10 to 15% of the properties start getting real water damage, like unlivable, right? Like foundations are sinking and collapsing, whatever have you. The rich people are then just going to lobby and say this was an act of God. This is like a federal emergency. This is on the scale of Katrina that we couldn't have predicted, and the federal government needs to bail us out. And you know what the federal government's going to do? They're going to bail them out. As much as you like hate that the rich are really good at doing that, but like they're all in the same social circle. And so in this case, in a much smaller example, one of the things I felt was like, okay, I am buying properties that have really strong rent to purchase ratios, really boring, right? Generally in working classes, like most of my tenants are like immigrants, it's multiple families living in one household. Like I feel really good about providing quality housing for, like working class Americans. And so let's say, as COVID happened, more than 50% of them suddenly can't pay their rent. Did I really, do you really think that if this is a national problem, that the federal government is not going to do something to make it so you're not going to suddenly, mint thousands, tens of thousands of homeless families who, in many ways, could make the argument it was an act of God. Like COVID shouldn't have been an act of God to our government, right? But to the normal person, it truly was just like, one day you're working and the next day we're all locked down and you can't make money, right? No, I did not believe that. It's housing is kind of this like really interesting sector, which is almost like healthcare, where we agree that it's almost like a foundational good you have to consume for society to function. And lo and behold, that's exactly what happened, right? You had eviction freezes happen across the country. You had rent relief happen. And yes, it took a long period of time. Don't get me wrong. There were many months where I did not get any cash flow from my properties, but at the same time, I still built enough resilience into my portfolio that I never worried about my mortgages, right? So I wasn't drawing income from it, but at the same time, I didn't have to worry about paying my bills from that side. And so even though it took about 6 to 12 months, eventually the state of Rhode Island, who got money from the federal government, right, was able to process rent relief for a lot of my tenants. And so I was able to get nearly, I believe all, I'd have to check the financials, but if not all, then nearly all of the due rents that were due during that period of time. And so if anything, if nothing else, what that shows to me is as long as you are not reckless with your financials, right? And that's why even in startup investing, you see like the first section I write in every deal memo is like, what are the financials, right? Does it have revenue? What's the valuation? What's the burn? Like, what was the net income in the last period of time? And so with real estate, it's the same thing. As long as you don't get reckless with financials, you build, you don't assume 12 months of vacancy every year. That's ideal case scenario, right? As long as those are what's going on, and here's the other thing I'll say to kind of really wrap that up. The brutal part of it too is with real estate is if you think about who you're competing with, Stefan, like, gosh, like if you take my work experience, the fact that I do financial modeling, the fact that I have property management teams and like, just clean P&Ls every single month, like you're competing against someone who probably fell into being a landlord to be honest, right? Someone who is not a professional manager. It's not hard competition to overcome in terms of being a real estate investor, right? It's that's kind of the brutal truth of it in my experience. So all of that said together, I know what you mean. There's a lot of mortgages that are being minted because money is free right now, right? I think from a combination of regulation that happened right after '08, there was a lot of regulation that changed. We don't really have kind of like the same like predatory adjustable rate mortgages that are happening on here. The amount of like kind of combined financial engineering that's happening through debts being sold, like this Ponzi house scheme, has also been kind of significantly more regulated. I don't think you're going to have anything like that, right? I do think we corrected for what happened in '08. I don't think you're going to have that. To the level of your tenants not paying rent, that will absolutely happen. I think any landlord who has not gone through a financial correction is, still needs to go through that. I now have gone through that. And as I kind of experience, it's like, well, America isn't going to let tens of thousands, hundreds of thousands of working class families suddenly just go homeless, right? That would be a really expensive problem to then solve after the fact. So realistically, what happens is you go for a few months without cash, they make it up to you, and then you keep proceeding. And then finally, even just from like a pure financial standpoint, I am in the market right now to buy more properties, and I can guarantee you that every single property is now worth more than when I bought. Like, I'm actually somewhat irritated at how high the prices have gone, because I know what I paid for that same kind of 3-family, 6-family 1 to 2 years ago, right? Like, everything is minimum 50 to 100 to $150,000 more expensive than it was a year to 2 years ago. And despite that, I am still buying. Because the rent to purchase ratio still makes sense, and it's still an asset class that I can make. So I believe that, yeah, for people in our age group, we can be a little bit more kind of like traumatized from the financial crisis of housing, but I don't think it's going to be. I don't think it's going to be housing. I think housing has delivered well this time. I personally do not worry about it.
Very cool. And just to follow up on mortgages, to the first time home buyer or commercial real estate buyer, and they're looking for a mortgage, do you go to one mortgage lender, or are you comparing 5 or 10, 15 different mortgage lenders to find the best rate? How do you find the best rate?
I have tried to go directly to multiple institutions. So I've gotten in New England specifically, we have this program called like a heat loan program. And what they do is that, a lot of New England's houses are really old, so they don't actually have the most fuel efficient heat systems. So you get a heat loan, it's a 0% interest. The state pays for the interest. The bank gets the interest from the state, and then you, the owner, pay the principal. So everyone kind of wins, right? The owner gets, as an interest-free loan to upgrade their heating systems. It's more efficient. The bank makes money on both sides of the thing, and the state actually gets money because they are getting more energy efficient heating systems throughout the state. So that's kind of the try and win there. So in order to get that, you have to apply for a small commercial interest-free loan from banks. So I actually did have some relationships to the local banks in Rhode Island when I was applying. And so when I had that experience, I will candidly tell you, it was mostly a waste of time. And this is what I mean when I say like real estate is so stable, and like the cottage industries that it has really supported, just really inefficient processes, like nothing that you and I would ever tolerate in technology. And so finally, what did ultimately kind of crack the nut for me, and who I hope to do business with for a long period of time, is these like this class of professionals called mortgage brokers. So you want to look for someone who's like a commercial mortgage broker. Bigger Pockets has them. If you want, I can connect offline and tell you who mine is. I think they're nationwide. But again, it's very case by case in that kind of sense as well. You can shop for multiple brokers, whichever one works with you. And my broker, honestly, I give him so much credit. He really kind of like held me by the hand for a year before finally we got a deal over the finish line. And now I'm like, great. I just want you to broker, compare all the rates for me, tell me what's good, and then let's. At this point, it's actually, I don't even really care that much more about 0.25% DX as long as I get to move fast, right? And he's telling me, again, like $2 million line of credit, buy, repair, rent, refinance, and the seasoning periods of like 6 months, right? Where I'm like, wow. And what he was saying was actually, he was like, not before financial crisis, before COVID, they actually had seasoning periods of like 3 months. So people were buying, repairing, renting, refinancing properties completely in 90 days, which is breathtaking and somewhat overwhelming, right? I'm not that big. I'm not a professional full-time real estate investor, but it's cool to know that those options exist for us as even though we are self-employed.
Wow. And you mentioned the rent to home value ratio. Are you also looking at your cash on cash return? Like, what's the most important metric for you?
I always look at rent to purchase ratio, because once you do rent to purchase ratio, every other number makes sense. Every single other number makes sense. Yeah. For leverage cash on cash return, I minimum try to target 10%. And generally I've outperformed 10%. But that's to me is, again, I'm a really conservative modeler, right? Like I always assume that repairs go a little bit longer, that rents don't grow as quickly as you like, and that vacancy will be higher than you will. So I like to manage my own expectations that way. So I'm not resting on something that ultimately doesn't materialize.
What is leveraged cash on cash return?
So actually, this is actually how my business model works. So one of the competitive advantages I have, and I will fully own, is that I can buy houses in cash. And so I can buy really dilapidated stuff that the bank will not finance. Now, how do I finance those, right? Because it's like when I first got started, I did not have $170,000 in cash. So I go through a hard money lender. And in this case, my hard money lender actually is my family. So I loan money from them. I loan money specifically from my mother. She has a cost of capital that she borrows from the bank, and then I pay her a DX on top of that. And so that's how we're able to buy properties in cash, repair them, rent them, refinance them. And then once I get that refinance, right, the mortgage gives me a lump sum of cash. I pay her back. pay her back with interest, and then kind of again we have capital to go and do this all over again. So what that means is for most people, when you're buying a property, you don't have, if you're kind of in the Austin market, I'll just take a shot in the dark here. You probably don't have $450,000 to buy a starter home, single family home in the Austin market, right? And so what happens is you have to get a mortgage for that. But what it means is, when you get a 30-year mortgage, after 30 years, you will own that property free and clear. So that 450,000, not even forgetting inflation, sorry, not inflation, appreciation is all going to be yours. So the cap rate is what the kind of, if you take out all the numbers, regardless of how you finance the deal. Let's go back to my example of the $2,700 a month rent on a $170,000 basis, right? If you were to look at that cap rate, when I did it out in my spreadsheet, it ended up becoming something like 8%. So the cap rate is all of the rents, multiply it by how many months you're going to occupy it minus all your costs. So I took out water, sewage, maintenance, repair, vacancy, property management, everything. It came out to be at about 8%, which means that once I own this property free and clear, 30 years or 29 and some chump change, I will make 8% of my money back on the price that I paid and put into it. So 170,000. So if you do, you can do that math now. So we do 170,000 times 0.08. That means that theoretically that property will make me $13,000 in income every year, like gross after paying for all stuff. Now, if I was to just do that, $170,000 is a lot of money, right? I would only be able to do that one property. But because the property is solid and, there's appreciation, all this stuff, the bank will loan me money against my asset as long as I pay them the monthly mortgage. And as it so happens, I got so fortunate, and also, I guess I'm not bad at real estate investing, that my property's appraised value was so high that I was able to have no money left in that property when I cashed out. Does that make sense? So in terms of like as an investment, within 2 years, I got all my money back, and this property pays me residual income every single year forever. So that's a very, very outsized result. Like I hope that's kind of like venture capital, right? Like you certainly hope that one of your startups will give you 10, 50, 20, 50 times, whatever have you. But you cannot assume that. You have to assume that most of them are going to die. And you have to be very stringent about looking for that company that you think will get you that percentage. And so when you look for an investment property in real estate, the leveraged rate of return is what your expected return is after you take debt onto it, which means like if you get a mortgage. So that means like after everything is all set, I've taken all my money out and all that stuff, I want to be making at least 10% a year, which really colloquially means that after the bank has loaned me as much money as they're willing to loan me, I want to make sure I'm getting my money, my Muhan's personal money, back within 10 years. That's all that really means. Yeah.
Got it. And when you're refining, when you're refining, it must be a lot easier to do that than to purchase a house. Is that right? Are they looking at W-2s and all that kind of stuff?
It is significantly easier, but like I said, this time for a residential loan, they will still look at W-2s. Now it's very much I will most likely never touch a residential loan again. It's probably going to be commercial for me just because it's so much faster and easier in every way.
Awesome.
Yeah, I will say it's a premium good. It costs more, right? Your interest rate is going to be 1 to 1.5% basis points higher, but the speed at which, and that's the reason for that is because the federal government is not backing your commercial loan. They do back your residential loan, right? Or they allow a bank to sell it. It's a mortgage back. It's a federal government backed kind of mortgage. But on a commercial loan, yes, the rate is higher, but then that means the lender is willing to qualify you on things that are not your W-2.
Got it. Interesting. Good stuff. I've learned a lot in an hour and 26 minutes. Just overall, is there anything else you're working on besides Startup Investing for All and real estate and kind of your media business?
I would say that I'm trying to think. No, I mean, that's certainly it. I would say that from a personal life standpoint, it's definitely been a journey. And I think a lot, actually, yeah, this is probably a good way to close it. When I was working at Yang's campaign, one of the things that we talked a lot about was how much can you sell an idea just based off of its idea and how much does it need to be sold by a messenger, right? And so when I was working for Yang's campaign, I was earlier in my career, I very much saw myself as like taking care of things. That's actually how I ended up becoming COO from the tech guy. So I built the website, I registered our bank account, I filed our regulations with the federal government, all right, with the Federal Election Commission. Like that's the reason why I know all these kind of like archaic, mundane regulations, because I actually have to make us follow it. And so in this stage of my career now, I kind of joke, I'm like doing what Andrew Yang did, except in venture capital, right? So I now blog at my name. Like, you build trust in me. I'm doing something very, obviously I want my readers to level up and make money and ultimately become competent angel investors themselves. But it's a transformation. It's a journey. You trust me that reading my content, investing alongside with me, being a part of the community ultimately will generate for you large outsized gains, right? But there's a faith in that idea. So that experience has been much more holistic and in many ways much more significant than just getting better at a job, right? So one of the things that I say as an angel investor now is that I want people to choose courage, competence, then capital in that order, right? And here's the thinking behind that. Even in founders, even in venture capital, capital is perfectly fungible, right? My money and your money are completely equal. There's no real difference. Like, that's why you want to choose smart money, right? Because otherwise, in addition, the Federal Reserve could literally just print all this money. It's the exact same money that you and I have. So capital is actually the least differentiated good. You can get that on demand, whatever have you, at any time. Competence is a little bit more interesting because we spend money to hire competent people. But as it turns out, competence is actually still learnable, right? You can learn to be competent, you can go to school to train it, and you can practice it. And competence, in that sense, it's not as linear as capital. You can't just print more competence, but you can learn more competence. So what it really comes down to is like courage is actually the number one scarce resource. And I really say courage could be substituted for many things. Courage could be vision. Courage could be timing. Like, courage means like you in that particular moment, in a moment of uncertainty, choosing to take a risk to do something, right? And so what that means for me is, working with Yang in 2017, he had really emphasized it. He had really emphasized, like, I guarantee you, by the end of this presidential cycle, no one will be talking about the problems that we're talking about. No one will come out and bet on universal basic income the way we will, because I've met these people and most of them are cowards. And that was a very haunting statement to receive in 2017. Sadly, now 4 years later, we can confirm he's completely correct, right? Now that he's done it, cash stipend is becoming more popular, but still, like, Joe Biden, right? Kamala Harris are not like, we need universal basic income. The most is like the earned income tax credit. So that statement, I think, is very provocative and applicable to just about everything. And so for even me in my stage now, I think besides the angel investing, besides the real estate investing, besides the media stuff, like, when I look at what is the limiting reactant to me, you can say gaining more influence, but really, like, ultimately at the end of the day, I want more people that I care about making money and backing companies of other people I care about. That's really what it is. Like, I would love for their, one of the missions I workshop is like, if I could get 1,000 me's or 1,000 you's, right, 1,000 investors to back like 1,000 founders of Andrew Yang's caliber, then that's like a really abundant society. Like, that's fabulous. I would have a really good time. I feel really great about my impact. And so when I look at the limiting reactant of that, I believe a lot of that, of course, for myself, still ends up being courage, right? Like, how much do I have the stomach to pitch myself to larger audiences, right? Like, how much do I have the stomach to have someone look more at my portfolio and really critique my investment decisions and really just be like an open kind of platform for talking honestly about how we make money in these things? And so I say that because that's much more of a personal journey, right? That's much more a personal journey about imposter syndrome, about limiting beliefs. Why would someone trust me to do those things? And that's, significantly much more personal development. But I really found that kind of in the journey to build anything meaningful and kind of outsized in terms of returns, that's the limiting reactant. And so that's, aside from, I think, just the professional stuff, like what I really wrestle with and work on from a day to day.
I love it. You're investing in ambitious founders, whether they will make it or not. You're taking a bet on courage, and I can really appreciate that.
Thank you, man. Yeah.
One last question. Why LA? Such a stark contrast from New York.
Yes, for sure. And it's a great question. That's why I say, like, That's why I say like I think this arc of my journey is much more personally informed. A couple of things, I suppose. One is that once I started the business, once I realized real estate was good, once all these things happened, I kind of realized that I was fully remote. I could be permanently remote forever, and so I love New York. I will be going back there soon. Just got to buy my flights for the holidays, but when I look at my personal growth, I knew that if I stayed in New York for another year, I would have done more of what I did before. Right, maybe a little bit better, maybe a marginal improvement, but it wouldn't have not been kind of a venture sized return. So I think one was, all right, I'm fully remote. I finally achieved this thing. Let me go and explore another area. Right, and so two, kind of on that note, I was like, all right, what's on the bucket list? What have I not? What have I always wanted to do, but I haven't done because I want to be prudent? Among them was coming out to the West Coast, right? You've heard from Boston, New York, Miami. I've been very much an East Coast guy, just by circumstance. And so now that I can go kind of beyond circumstance, I want to come to the West Coast, talk to my friends in the Bay. One of them in particular who really influenced me, really encouraged me to come to SoCal. He was like, no, NorCal is like very like suburb. It's very tech heavy, which is fantastic. But, I do think I have interest outside of just technology. So he encouraged me to come to LA. And so that's how I plopped here. Three, I'll say this as well. This is a little kind of like racially informed, but I am an Asian American. And what that means is like working for the Yang campaign, right? I was the first employee. I was the first Asian American employee. And really getting to meet Asian Americans on the campaign from various different geographies really informed me like, oh, interesting. Like the Asian experience on the West Coast is somewhat different and distinct from the East Coast. I think I was curious to explore that. Four was that, New York is great for media, but I think it's a fair statement to say LA is probably the media capital of the country. Right. And so being in media now, that was something I wanted to explore as well. And five is like very boring. I know you're like, wow, so many reasons for a move. Five was I very much wanted to experience a winter not in the Northeast this year. So my experiment was like, great, let's go somewhere warm.
Yeah, I mean, the South and being close to the water is actually really nice. I mean, Austin's probably 3 hours from the ocean, but the weather here is awesome. Besides the snowpocalypse that happened, that really sucked.
True exception. Well, I'll say this. I mean, I've only heard so many great things about Austin. Actually, the co-host of my podcast just moved to Austin. He's a space investor. So like, yeah, no, I mean, you guys are experiencing huge inflow. So I know there's a lot of good stuff in Texas.
Yeah. It's getting a little expensive here, but other than that, it's an awesome place to be. A lot of cool people. Cool, man. Well, thank you for your time. This was awesome. I definitely learned a lot. I'd love to riff some more in the future. And I plan to put this on my YouTube channel. So
fabulous. I love to do it again. And like, this is what I want to do more of. And, once I get my act together and start doing some scripting for some other stuff, I'd love to reciprocate. I'd love to talk about your experience as an angel investor, what you found, kind of is your bend and like what success looks like for making money, backing ambitious founders.
Definitely. Thanks again, Muhan. And I will see you later, sir.
Thank you so much, Stefan. Be well. All right.
Bye.